This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in our final session now on Chapter 3, we get introduced, as we, briefly did at the end of the previous session, to this new idea of lease premiums. Lease premiums, to begin with, being received on the grant of what we call a short lease. Not that short. 50 years or less here reckons it to be a short lease. The idea is that, as I think we mentioned at the very beginning of this chapter, that when an individual lessor, the person who owns that lease there, grants a lease to a lessee, this is normally on a commercial building that we're talking in terms of rather than residential, which has been the focus of our property income studies so far. But where the lessor grants a lease, a short lease, 50 years or less, so still pretty long, to a lessee, then other than just having within the lease agreement the terms of the rental payments that will be made to them over the period of the lease and on what regular basis rent reviews may take place, what may also be within that lease agreement is at the very beginning of it, a one-off payment will be made by the lessee to the lessor, and this is known as a lease premium. Now, this has got to come into the tax system. Again, HMRC are not going to ignore this payment for saying, oh, well, it's not rent, it's a premium, so we'll ignore it. Of course not. It's going to be brought into the taxation system. Now, thankfully, we don't have to worry about how the entirety of the amount received, the lease premium, is dealt with within the taxation system. Because what happens in real life is that the amount of premium received by the taxpayer is divided up in a mechanical way that we'll see in a moment between how much of that premium received on the grant of this short lease should be treated as income and therefore be a part of the property income assessment for the year in which it was received, and how much of that lease premium should be treated as a capital receipt and therefore charged under the CGT, the capital gains tax rules there. Now that CGT bit is not, thankfully, within our syllabus there. It doesn't even await you at your advanced taxation paper. It's not a part of our syllabus. All we have to deal with is the income component. But as you might think, that if we're dividing a one-off receipt of cash, this premium received, between income and capital, there's going to be some basis by which we split that total premium receipt between how much is income, how much is capital. And it works on a pretty common sense basis. That basically, if you were to grant a lease for just 1 year, then any premium that you might receive at the beginning of that 1 year lease is taxed entirely, 100% as income. But if you were to grant a lease of 51 years or more, so not short, a long lease, 51 years or more, then all of that amount received, given the length of time we're talking about, will be treated as a capital receipt and go into capital gains. So what you've got is now a sliding scale between 1 and 51 years. At 1 year length of lease, all the premium received is income. At 51 years or more, it is all capital. You're going to get one in between. So what we've got to identify and know how to compute is what is the income bit to be included within your property income assessment in the tax year in which you receive that premium. Okay, that's what we've got here, therefore. Okay, so when a tenant takes on a new lease, the lessee, the tenant there, the tenant may be required to pay a one-off premium in addition to any annual rent, which will be treated in our same normal way of a rent received basis. If the lease is for less than 50 years, part of the premium is assessed on the landlord as property income. The remainder, as we said, is treated as a capital receipt there, but that's outside the syllabus. So all we need to know is what bit is treated as income. And here we go, the amount is just treated as income is down to this little formula here. So P is the total premium. So they'll tell you what the total premium received was and the date, that will be the beginning of the lease period, that it was received. And we then multiply out by, now there's a bit you're going to have to learn. 51, remember, over 50 years, it is a long lease and therefore none of it is income, it is all capital. But 51 minus n, that's just the length of the lease, and we do that in years here. 51 minus n over 50. Now that's the way that you can go directly, the way I'd recommend, to be honest here, by which you compute directly the assessable property income figure. You can do it another way. The assessable premium may be computed as the full premium received, obviously again the first figure they give you in the question, which is then reduced by 2% of that premium for the number of years of the lease less 1 year. Now again, it's odd, but let's have a look at a little example to illustrate how we do this. And again, either technique is fine, but again, the one I'd recommend, and hence why it's in here first, this way. I mention this because depending again on what question bank, exam kit, revision kit you may be using, you may see either of these two alternate methods of calculation. So just so you don't think, where did that come from? I've mentioned it here as well. Now, here, awaiting us, is a little example for you to note down at this particular point in time. Now, we know that the person granting the lease is the lessor. So our example here, the lessor grants a 21-year lease. And where we're most likely to find this, itchy snitchy, is on a business property. 21-year lease on a business property to the lessee. So it's a business, therefore, that is paying the rental, that is paying this premium. And what we're going to have to do is to not just look at the situation for the lessor, but we'll also explain with this example the position for tax relief for payments made by the lessee. We'll see the link between it. So, lessor grants a 21-year lease. 21-year lease, therefore, that is not more than 50 years, and therefore on that basis, it is a short lease. And what happens? It's granted on the 1st of January 19, and the terms of the lease are: the lessor received a premium of £70,000 on that date. There's the one-off premium receipt. We are going to have to work out how much of it is to be treated as income, and what will be the income assessment in, well, 1st of January 19, we of course are going to be looking for our 2018-19 tax year of assessment. But of course, be careful what the question asks you. Again, this is like a 2-mark objective testing question. Does it ask you to work the property income assessment, which will be both the taxable part of that premium received and also will be any rental income received during the tax year? So the rental payment, the lease terms are an annual rental of £40,000, payable half yearly in advance. So payable half yearly, the lease kicks off on the 1st of January 19. So we'll have received on the 1st of January 19 half of the annual rent of £40,000. So the first bit to include now, rent received. That is going to be, of course, half. It's 1 out of 2 half-yearly receipts of the £40,000 equals 20,000. So the amount received on the 1st of January, next one with the 1st of July of 19 will be £20,000. So there's the first bit. We then need to deal with the premium. Now, again, be careful. Does the question ask you, if it's an OT question, be very careful reading the requirements. Does it ask you to pick up what the property income assessment is, which is what we are working here, which is this combination of rental income received plus the taxable part, the income tax taxable part of the premium of that premium there, the element that is income. Do they want both, or do they just want the taxable part of the premium there? So read that requirement carefully. Right. How do we therefore work out that part? Now, look back at your note. I'll just flash you back to that. There you go. There's your calculation. So we want first of all the premium. Well, we know what the premium is. It's £70,000 there. Again, just look back in that note. Received a premium of £70,000 on the 1st of January 19. 70,000 times 51 minus n over 50. What is n? The number of years of the lease? 21. And that will give us our one-off premium receipt here to be charged to income tax. So if you look at what we've got there, 51 minus 21, nice round number, that's 30. 30 over 50, 30 50ths, i.e. 60% of 70,000. Do put it through your calculator, but that I think should be £42,000 there. So the taxable part of the premium received there is £42,000. Now that is a one-off hit. So in our 2018-19 tax year, you've got the rental income, which will then on a £40,000 a year basis received, come up in each of the remaining years, full tax years, of that lease period of 21 years, but also just this one-off hit in 18-19 in relation to the premium, 70,000 received times 51, standard number, minus n, the number of years, over 50. That is 30 50ths. 60% of 70 is £42,000. Now, the other way that we said that you could learn this was the premium received, 70,000 less 2% for the number of years of the lease, 21, minus 1. It's a 21-year lease minus 1. That, therefore, is 20. 20 times 2% is 40%. Obviously, up here, we've taxed 60%. All I'm now doing is to work out the bit to be deducted from 100%. That is 40%. 40% of 70 is 28. Take it away, equals the self-same 42,000. It doesn't matter. This, again, straight to it formula is what I recommend. But if you see either of those, either is acceptable. Obviously, if it's an objective testing question, they're not looking at your workings anyway. It's just what is the right number. Have you picked that figure out? Now, again, be careful. If the question has asked for, in 1819, what is the taxable part of the premium received, that is the £42,000 that we have there. If they want the property income assessment for the 2018-19 tax year, it's both the 42,000 plus the £20,000 of rental income received, a total of £62,000 would therefore be that figure. Okay. Straightforward, mechanical exercise. You've got to do one thing and memorise. You have to learn. Sadly, that's not on your rates and allowances page. You've got to learn that calculation there. All right, let's go back to our notes. Again, at this point, you've got a little exercise there for you to practice on yourself. And notice it says the property income assessment for Bill in 2018-19. I've just shown you what to do. You have a go at that one. Pause at this particular point in time and then check that out with the answer in the back, please. And then rejoin us, because having now dealt with the lessor, we need to look at what is the position for the lessee. That is what we'll deal with in the next part of this lecture. So just pause and work that exercise for me now, please. Okay, well, hopefully you were okay. You were good in terms of that exercise, and we're okay now with working out how to determine on any premium received on the granting of a short lease there what the income element is to be taxed as property income in our relevant tax year 2018-19. Okay, but we said that the most likely property to be involved would be a business, a commercial property therefore. And therefore it is a business, whether that's an unincorporated trader or a corporate trader there, company, who has paid not only the rental each year, each due date, but also at the very beginning of the lease has paid this premium. Now then, let's think about it. If you have acquired a leasehold property for use within your trade, do you think that your rent that you pay, the payable rental for your accounting year as a business, do you think that to be an allowable expense? Is that an expense that you would normally incur here wholly and exclusively for the purpose of the trade? Of course it is. So rental payment, as you'll see in the next chapter, chapter 4, is an allowable deduction. But what about, therefore, this one-off premium? What we will see now is that for the lessee, the business paying that premium, some part of that premium paid, in our example £70,000, some part of it will attract tax relief, and what we'll be able to work out is not a one-off relievable figure in the period in which they paid that premium, but what will be an annual trading profit deduction for the business to take throughout each of the years of that lease. That's what we're looking at now. It will lead us, lead you indeed nicely through to chapter 4, which is, of course, the next chapter when we finished this particular chapter 3, which deals with the whole exercise of foreign business, for us at this part in our income tax studies, an unincorporated trader. They prepared their accounts for a given accounting period. They have a choice of accounting date. And for that period, we prepared financial statements, a statement of profit or loss. It will identify an accounting profit. What we will have to do for taxation purposes is to make that acceptable for taxation purposes. It has to be adjusted. The financial accounting profit figure is not going to be the profit figure that ends up in an income tax computation as the assessable trading income. That exercise of adjustment of profits is something that will be tested on you in this exam in some way, shape or form, whether it's objective testing question or questions or part of a written question in section C. You will be tested on adjustment of profits, whether that is for an unincorporated trader, as we deal with in chapter 4, or whether it's for an incorporated trader that will deal in the corporation tax part of these notes, this course. That I don't know, but you will be tested on it, so it's an important issue. One of the issues you may have to deal with is that during the accounting period concerned, the business has paid this premium. So what have we got here? Where a trader has paid a premium for a short lease, again, we've identified what we mean by that, he may deduct the following annual amount. So it's not a one-off deduction, it's an annual trading profit deduction, so against his trading profit in each of the years of the lease in which the property is used in the trade. Now this is on top of course, for any accounting period, the amount of rental that was payable for that period. So it's in addition to any rental cost incurred. So how do we work out this per annum, this annual trading profit deduction? Simple. To be able to do this, you need to know the first part. How do we work for the lessor the property income assessment on that lessor, on the landlord, the person who owns that building? So that is the first figure. So if you are dealing with as well, you may in an exam question, the lessee, you still need to know how to deal with the lessor, because you need to be able to work out the property income assessment on the landlord as we have just seen. And that is then spread over the number of years of the lease, the life of that lease. And that gives you an annual figure there. It gives you an annual figure. Right. Before I leave you to have a little go at example 6, I'll just get you here to look back to the example I had running in relation to our lessor and lessee. Now then, the lessee, you're dealing with their trading profit and the calculation of their so-called adjusted trading profit. You do that for an accounting period. Again, not all unincorporated traders may choose to prepare their accounts to the 5th of April, just to make it synonymous with the tax year. You can choose any accounting date that you will. So what we've got to be able to do, therefore, is to be able to deal with the accounting period in which the lessee has paid that premium and, of course, any rental due. So let's here again give some further information. You know that on the 1st of January 19, the lease was taken out and the lessor received the premium of 70. The lessee paid that premium on the 1st of January 19. And also on that date, the first rental payment. Rental was on an annual rent of 40,000 and it was payable half yearly in advance. Right, let's have a look now at the lessee. Now, the first thing we need to know for the lessee is which accounting date are we dealing? In which accounting period does this lease premium fall? Let us therefore now, you'd be told this in the question, you don't have to make it up. You are told now that the business, the lessee's business, prepared accounts to the year ended 31st of March. So in which case the 1st of January 19 would have been in the year ended the 31st of January 19. And in the question they'll have told you about, as I have told you, the amount of premium that was paid and when it was paid, the length of lease, and also the annual rent for that lease period. What we've got to do is now work out what the allowable deductions will be in this year, the year ended 31st of March 19. Okay, let's deal with the rental bit. Rental payable. When dealing with trading profits, we work on an accruals basis. In business, trades, financial statements, we work, in the most part anyway, on an accruals basis. Always for financial statements and usually for taxation. That will be the default setting. We use the accruals basis. So what would be the rental payable in that year ended 31st of March 19? We're working at accruals basis, so the dates when it may or may not have been paid are irrelevant. All we need to know is that the annual rental is £40,000. This lease was taken out on the 1st of January 19. 1st of January 19 within the year ended March 19. So how many months worth of the 21-year lease fell within this accounting period? And very obviously, from the 1st of January 19 to the 31st of March 19, it's 3 months. Therefore, 3/12 of that overall annual rental payable. Doesn't matter that what the business will have paid is £20,000 on the 1st of January of 19, that half-yearly payment, we work on an accruals basis. How many months from the date you paid that, you started that lease, to the end of the accounting period, it's 3 months. So 3/12 of 40,000 is £10,000. For the next year end and for year ends thereafter, firstly the year ended 31st of March 20, the annual rental payable, £40,000. That will of course be your trading profit deduction. Only 3 months of that 21-year lease period falls in this accounting period. 3 months worth, 3/12 of 40 is 10,000. We've then got to deal with the premium payment. Now we're working an annual trading profit deduction. An annual trading profit deduction. So what figures did we need? We needed to begin with, on the top line of this calculation, the income assessment on the lessor, on the landlord. We'll look back to the example that we did, and we worked out a property income assessment in relation to the premium of 42,000. Whichever way you did it, it was £42,000. So 42,000, the property income assessment on the lessor, on the landlord, divide by the number of years of the lease. Now you see why I use these strange numbers. because 42,000 divided by 21 years is £2,000 per annum. Per annum. What that means is, though the lessee paid £70,000, the bit that can be treated as an expense item rather than a capital payment is based on the property income assessment on the lessor. That was 42,000. Sadly, the lessee doesn't get to deduct all of that in one payment, in one accounting period. No, it's spread over the number of years of the lease. So that therefore gives us £2,000 per annum. And in each full accounting period in which the lease runs, through which the lease runs, you'll get on top of any rental payable as an allowable deduction against the profits of that period for taxation, you'll get another £2,000. But just as we've seen with the rent, there's only 3 months worth of this lease period falling within this accounting period. So that will be times 3/12. 3/12 of that annual figure of 2,000 is 500. So the total allowable deduction when working the trading profit for this lessee for his or her accounting year ended the 31st of March 19 is going to be £10,500. £10,000 of rental payable for that period and £500, therefore 3 months worth of what would be an annual trading profit deduction thereafter of £2,000. Good. So we should now therefore be able to deal with either the lessor or the lessee. The lessee is the most interesting one because you still need to be able to do what you do for the lessor, work out the property income assessment, and then take it those steps or that step further and actually work out for the lessee what their annual trading profit deduction will be. If we're then looking at the period in which it was actually paid, remember to time apportion how much of the lease period fell within that accounting period, because this is a per annum, this is an annual figure that we're talking about here. Okay, so back in your notes there, you've got example 6 to have a go at, based on what we saw, actually in example 5 there, isn't it? After I'm in that one. Here it says example 4, that of course is example 5. Show the relief available to Richard for the premium paid. So again, have a go at that, please. Check it out with the answer and then come back and join us for a tiny little bit of extra on these individual savings accounts. Okay, on to individual savings accounts, ISAs. Now, you've actually seen reference to this back in chapter 2. Might seem like a long time ago now, but we saw it in a list of exempt income. Income from an ISA, an individual savings account. For many years, the most common form of tax-efficient investment. Of tax-efficient investment. Now then, components of an ISA. Pardon me. 2 main forms of income will derive from an individual savings account. They are interest income based on, usually as here, cash deposits made, usually in a bank, paying interest there on. The interest from that ISA is exempt from income tax. This is the point, tax-efficient investment, income from your ISA is exempt. So it could be interest. It might not just be a cash deposit that you put in a bank through their ISA, the individual savings accounts that the banks run there, but maybe an investment in either interest-bearing stocks or, of course, shares. Now, if it's a security, you've got stocks there, then that again will generate interest. And any such interest received, again, is going to be exempt. If you've got shares, then it's dividend income that will come in. So the income that you'll see coming through an ISA is a combination of, or one or other of, interest income and dividend income. And through that ISA, it will be exempt. Now, for many, many years, this was the most tax-efficient form of gaining such income. Rather than holding the deposits personally through a separate account, or indeed the shares, you put these into the deposits, the shares, into an individual savings account, which meant that the income that derived therefrom was going to be exempt from income tax. Now, of course, in more recent years, we've seen very important changes in how those two types of income are taxed. And you already know that in relation to interest income, there is not just a 0% starting rate band available, which of course may not be applicable and probably isn't applicable to most taxpayers because they've got too much non-savings income, so the starting rate isn't available to them. But they do have a savings income nil rate band. If they happen to be a basic or higher rate taxpayer, they have a savings income nil rate band. And in dividends, we have a dividend income nil rate band. And those introductions, therefore, have not entirely removed the benefit of an ISA, but have served for many to take away the reason for putting their deposits into an ISA. Let's see what we've got. The main advantages, as we know, income is free of income tax, whether it's interest income or dividend income. There's no limits like there is on a savings income nil rate band or dividend income nil rate band in terms of the income derived from the ISA. Where the limits apply is how much in each tax year you're allowed to invest in an ISA. And that's the bit that will come in down here, the subscription limits. So income is free of income tax. If we've only got small amounts, then you've got a savings income nil rate band, you've got a dividend income nil rate band. That therefore might mean you don't need an ISA to have such small deposits, to have such small holdings of shares. But if you go bigger levels, then they still be worthwhile. But then there's another reason why we achieve tax advantage and may still wish to use an ISA. Disposals of investments within an ISA, now basically we're talking about shares here being the ones that would give rise to a chargeable gain, but they are free from CGT. They're exempt capital gains tax. So any level of shares held within an ISA when disposed of will be free from CGT. No minimum holding period here. Again, doesn't matter when you dispose of them. If they were allowable in terms of the acquisitions of those to go into the ISA when they are disposed of, they will be free of CGT. As we've said, the introduction of the savings income and dividend income nil rate bands have removed the main benefits to most taxpayers, because those dividend figures, those interest income figures will be exempt anyway. As a result, we don't need an ISA. The ISA, however, still gives advantage to taxpayers with larger amounts of such income. If you've got more than £1,000 or more than £500 worth there of interest income, or of course if you're an additional rate taxpayer, and of course if you've got more than £2,000 worth of dividend income. And also for taxpayers selling shares, where new bit coming up, they have already made full use of their annual exempt amount. Oh, pardon me. Oh. I've been feeling that one coming on for a while. I think I have the sneeze at bay. Hopefully, again, pardon me for a moment there, we can get through the rest of it without me sneezing all over the camera. Okay, in income tax, we have a personal allowance, which is a level of tax-free income. In CGT, we have an annual exempt amount, a level of tax-free gains. But if you had an individual selling lots of shares, making lots of gains, that may indeed exceed that AEA, and then this would be worthwhile. Final bits here. Subscription limits. Again, basically £20,000 a year. Again, if you want to take full advantage of ISAs there, and you can split that any which way you like, between your cash deposits and between your shares held within the ISA. Okay, again, you can read and learn about those later in your studies. Where we go next in terms of Chapter 4, we'll be dealing with, indeed, trades. I do apologise. Dealing with trades, and we'll be having a look at how, when we start with an accounting profit, we're going to adjust that and make it acceptable for taxation purposes. We're not going to produce an entirely new taxation profit and loss account. We are going to adjust what we've already got, the accounting figure, and make it acceptable for taxation purposes. That's going to mean a whole lot of learning and practice for you, because there's a whole lot of rules that will dictate the allowability of expenses. We'll discuss that next time.